Hello for all joining in. We're just waiting for everyone to get admitted into the room, and then we'll get started here shortly. All right, I'll go ahead and get started here. Good afternoon, everyone. My name is Jackie, and welcome to today's webinar. I am with the New Mexico Small Business Development Center. Today, we have Cathie Tardy joining us, who is a certified SCORED member, is a CPA, and holds an MBA in tax accounting. She has been president of her accounting firm for 31 years. Cathie will be presenting tax strategies, keeping your profits in your pocket. We will be using the Q&A function to take questions and welcome attendee participation, so please don't hesitate to ask any questions that you may have during the webinar. We will answer them as we go along. This slide features some COVID-19 business resources links, which I won't go over in detail as you will be receiving a copy of the presentation at the end of the webinar. Please visit our website at nmsbdc.org to view our upcoming no-cost webinars or to sign up for our no-cost counseling services. I will send a follow-up email to all of you with this information, so don't worry about jotting it down. And again, thank you so much for joining us. Without further ado, I'll hand you over to Cathie.
Good afternoon. Thanks for attending. We're going to be talking today about keeping our profits in our pockets. And so I'm going to cover basically 10 different items that we need to be aware of and be thinking about when we're doing our planning so we can make that happen, keep our profits in our pockets. So let's talk about tax planning. Where does it really begin? How do we do that? What do we have to think about to know how to move forward with our planning? So one of the first things we need to look at is consider the economy. As you all know, there's all kinds of things going on. This whole year has been full of ups and downs and sideways and all different kinds of things happening. And so we know we've got inflation, we've got potentially recession, we've got rising interest rates, we've got high oil and gas prices, we've got all kinds of things happening. But really, we want to consider how it impacts our line of business. And so what are the things that are really happening that can make or break our 2022, 2023? And how do we find out what these items are if we're not really intimately familiar with how these economic items will impact us? And one of the best ways to do this is to talk with your industry groups, because a lot of the groups will have their own economic advisors and they can give you specific information about how it's going to impact your particular industry. So when we're doing planning, what we want to do is start with our projections. We want to project not only our year-end business income, but we want to look forward and be really projecting. I usually say at least 3 years out. And I know people always give me flack about that because I don't even know how to project for this year. How am I going to do 3? But really, thing that is so important when you're doing planning for your business is to be thinking ahead and to set up goals and plans for yourself. And to achieve those goals, you're going to need to have some kind of plan, some kind of projection. So not just, revenues and expenses, but we need to be thinking too about our cash position. We just heard that our interest rates are rising. How is this going to impact our current lines of credit? What about credit cards? What's going to happen there? And even overall credit availability. And so these are major things that will impact our projections as we're working through them. And we need to understand how we're going to get the cash we need to achieve the goals that we're setting for ourselves. Along with the projections and plannings for your business, I also have to remind my clients and others, that I'm speaking to, that we have to look at our personal tax situation. And the reason that I say this is because predominantly our small businesses are pass-through entities, meaning we file tax returns personally that include this pass-through income from those entities, be it a LLC or a partnership or an S corp. And then, of course, if we're filing as a sole proprietorship, it's right there on our Form 1040. So along with projecting our revenues, expenses, cash flows for our business, we also have to do the same thing for our personal situation. And if you're a single individual, it's a lot easier to do that. But if you're married and your spouse is working as well, there's going to be some tax impacts and some impacts to your tax bracket, so your overall income tax rate. So besides looking again at the business, we want to look at personal expenses, what's going to be a tax deductible item on the personal side for us, and what our cash needs are as well. So again, we're trying to keep our profits in our pockets. So let's look at the first item I wanted to talk about in relation to all of this as far as taxes go. What's your filing status? That seems like the most simple question on the tax return. What's your filing status? But it's over the last few years, and for the last number of years, it's really gotten a lot more complicated. So if you're single and you have no children or others that are relying on you, it's pretty straightforward. But potentially you could be filing as head of household if you're single and you're providing over half the cost of support for a qualifying person. You may be married, and so your options are married filing jointly or married filing separate. Generally in New Mexico, we don't recommend married separate because that tends to be the highest rate, and married separate doesn't really provide any shifting of income, because in the community property state, earnings from sweat of brow are divided equally if you're married. Divorce is an interesting aspect of this as well, because the IRS says your status is as of the last day of the year. So if you get a divorce on December 30th, you can file single for that year. So that's something to consider, looking at what year potentially is better. If you wait a couple more days, is that the best for all? And along with divorce, of course, there's separate property, which can be separately treated and is not treated as community and split equally. But then again, we talked about the community property split. So divorce can have an impact on your filing status for the year. During the year, you may also have a child that was born, or maybe you moved in an elderly parent into your home who you're now caring for. So these can all have an impact on your filing status. So don't just take the first glance at it. Think about it carefully to see what's going to be the best for you. Along with filing status, of course, we have to look at who's a dependent to qualify for some of these statuses. So we have two different types of dependents these days, IRS rulings. We have a qualifying child versus a qualifying relative. So a dependent, to be one of these, must be filing either single, married filing separate, or married but only filing to get return of withheld taxes and not qualify for any credits or that type of thing. They must be a citizen for at least part of the year, meaning a US citizen, a national or resident alien, Canadian or Mexican resident. And the support must be provided at least halfway by the taxpayer who's trying to claim the dependent. So let's talk about qualifying child. So there's really not just the normal son, daughter, stepchild, but also foster children, adopted children, or even potentially grandchildren, or they could be brother, sister, half brother, half sister. So again, like I say, if you are single, but you're supporting someone, you actually could have a dependent that may qualify you for head of household status. There is an age test for qualifying child. They must be under age 19 or under 24 and a full-time student. And then there's some special rules about if they're permanently and totally disabled. But their principal place of abode must be with the taxpayer for more than half the year, unless they have an exemption for some kind of sickness, education, other items you see here on the slide. Now, education includes college. I've had clients say, oh, well, they're at college, so they don't actually live with me. Well, that doesn't matter if they qualify in other ways. The time they spend at school can be treated as time living in the taxpayer's home. Now let's talk about qualifying relative. So actually, basically all the people who could be a qualifying child could also be a qualifying relative, but now we've added some additional individuals such as an uncle, niece, nephew, and in-laws. So really there's quite a few people who again could qualify as dependent. You must of course be their principal place of abode for more than half of the year, and you get the similar kinds of exemptions for sickness, education, vacation, that kind of thing. The one most different item is that to qualify as your dependent, their gross income must be less than $4,400 in 2022. The nice thing about having a child or other dependent is a potential tax credit that these children or other individuals would allow you to qualify for. And the children, so 2021 had special sort of COVID related child tax credits and advanced tax credits. Those are gone. For 2022, we go back to pretty much the old rules for child independent tax credits, of which per child you get a $2,000 credit, or the other dependent status, you would get a $500 credit. There are some phase outs of modified adjusted gross income for married filing jointly at $400,000, and for any other filing status, $200,000. And once you hit that adjusted gross income amount, the credits are no longer available to you. There is a refundable portion of the child tax credit, and it's projected to be $1,500 again per child for 2022. Now let's kind of jump to a different bucket here. Another item to help us keep our profits in our pockets is to be considering retirement plans when we're thinking about tax planning and tax projections. And being able to maximize contributions into some of these plans could perhaps save you some tax dollars. There's a lot of different kinds of retirement plans out there now. We've got 401k, solo 401k, we've got the SEP, we've got a simple, and we've got Roth, and those last three are considered IRAs. And some of the things we want to talk about is when do you have to establish the plan? And always, compounding makes your plan grow faster. So earlier contributions, meaning as you're a younger person versus just a few years before retirement, will make those plans balances grow much faster. So let's talk about the dates. So these are the dates the plans must be set up by. So for a safe harbor 401k, they must be set up by October 1st for contributions to make the business tax filing deadlines. And this is for October 1st for the plan to be in effect for the subsequent year. a solo 401k, which is basically a solo 401, basically a 401k for just one individual. And this is normally, we would see perhaps there's one owner of an S corporation who has no employees. They may be some kind of professional service organization, but basically any one person business. These can be established up to December 31st, and contributions be made by the due date of the business's tax return. So that could be a plus. Roth and regular IRAs have to be set up and funded by April 15th. The SEP, on the other hand, has a special rule where you can actually set it up and contribute to it by the date of the business tax return due date, including extensions. So sometimes as a sort of last minute planning opportunity, we decide to set up a SEP for the year. So let's say it's 2022 and it's September and we're thinking, wow, we made quite a bit more money than we expected. We want to do a little tax sheltering. We want to set up a plan. And so we maybe can't get it set up by October 1st. So we can't set up a safe harbor 401k. So we may decide to go with a SEP.
Hey, Cathie.
Yes.
We have two questions.
Okay.
So in the Q&A, we have someone who is a Mexican resident could qualify as a dependent. That is a question.
Yes.
All right. And then I have in the chat, can you do an SEP if you have one employee only?
I guess my follow-up question would be, is the owner the only employee, or is it the owner and one employee? Because so the SEP sometimes is not as advantageous for an owner with one employee, because if the owner wants to put in 25% for the owner must also put in 25% for the employee. So yes, you can have just one employee. And if it's an owner, it makes it easier. But if you have an employee, remember that the percentage of contributions you make must be exactly the same for all participants.
Yeah, it says here, no owner and one employee.
No owner and one employee?
That's what it says.
Okay. Yeah. So all employees are eligible. So even if the owner doesn't participate, the owner is still technically part of the SEP. And so there are also some rules about what you can only be eligible for one plan during the year. So you couldn't have an owner who had a SEP and only the employee was contributing, where the owner was putting money into, say, a regular IRA. You can only have one.
Okay, Cathie, you're back. Sorry, a little bit of technical difficulty.
That's okay. Let me make sure I give you the right screen.
Yeah, so right now I see you and there's the slides. Good.
Okay. So I don't know where I dropped out. But I was saying that sometimes if there's employees involved, a simple may be better than an SEP, in that the rules are a little bit less restrictive. An SEP, if the employer doesn't contribute, the employer still can't contribute to any other plan, because you're only allowed one plan during the year. So a simple may be better. The simple date for establishment is October 1st, and it qualifies for the next year to be implemented. And again, this is to give everyone a little bit of time to know if they want to make contributions to the plan. So this, involves employees, giving everyone the opportunity. Oops. Sorry about that. My slides weren't advancing, and then they did. So we talked about the dates. And one of the things I wanted to mention is, so it's already May and it's going to be Memorial Day soon. And so the years fly by. And so we have to be thinking about if we're going to establish a retirement plan, because if we're going to try to set up like a 401k, for example, we've got to meet with the plan administrator or the plan administrator who's going to be developing the plan, lining out what it is that we want. And so this process takes time. So you can't just show up last minute and get something going. Now, with the SEP, we kind of said, well, you really can do that. But let's plan ahead. Let's think about what's really the best for us and for our employees, and then give ourselves some time to implement these plans. So we really should start thinking about setting up the SEP, the simple, the 401ks, about now, and see how that's going to move forward, and talk to our employees and see, what their needs are, if they'd like to contribute, what the employer contribution amounts will be. So there's a lot of decisions to be made. So don't wait till the very last day to try to set these things up. So the retirement plans have different maximum contributions amount. The best plans for maximizing contributions are the 401k and the solo 401k. So we can contribute for the 401k $67,500 per year. These numbers do index. But that's the maximum deferral we can contribute. So it's the 61,000 if we're 50 and under, and if we're over 50, we get an extra $6,500 catch up, and employer contributions can be up to 25%. So overall, there's a contribution limit as to dollar amounts, and so that brings us to the 67.5 maximum, which is the combination of both employee deferral amounts and employer contributions. The same amounts apply to the solo 401k. So if you're some kind of service provider and you're earning a lot of money and you don't have a lot of expenses, sometimes this is ideal for those types of businesses. For Roth and regular IRA, the maximum contribution is $6,000 per year. And if you're over 50, it's $7,000. Now, a Roth contribution is not an income tax deductible contribution, because remember, the money you put into a Roth grows tax-free, whereas regular IRA, you would get a tax deduction for making the contribution. And again, it grows tax-free, but any dollar you take out of the regular IRA is going to be taxable when you remove it, whereas any dollar you take out of your Roth IRA will not be taxed. The nice thing about both of these plans is that if your income is on the lower side and you're still making retirement contributions, you may qualify for a saver's credit. So that's a great little keep a profits in our pockets thing to remember. Now, the SEP is calculated, and the maximum contributions are based on your self-employment income. So if you're a Schedule C earner, you could contribute up to 20% of your amount, your net income amount that you show on your Schedule C for the year. If you're an S Corp, you can contribute 25% of what's shown in your box 1. So essentially, it's evening out because the Schedule C has not reflected the reduction for the employer portion of self-employment taxes or the Social Security, Medicare taxes. So that's kind of how it evens out. The simple plan, again, maximum contribution is 14,000 plus another 3,000 if you're 50 and older, or up to 100% of compensation. Sometimes we have separate businesses that don't run afoul of a having to have the same 401k, any kind of retirement plan similarities. So sometimes, or maybe even you have a W-2 job and you also have a small business. So you could be contributing to your 401k through work, and maybe you set up a simple on your Schedule C. And so you could contribute up to 100% of your compensation, not to exceed this 17,000 if you are over 50. Okay, switching gears again here. This is one of my other points for keeping profits in our pockets. I wanted to talk about the code section 179. And most people know about it as a special expensing. But basically what section 179 says is that instead of capitalizing an item that has a useful life in excess of a year, we can actually just deduct the whole thing in the first year. And so sometimes that's a really nice opportunity to reduce our income taxes for the current year. For 2022, we can purchase up to $2.7 million of items without having a reduction in the amount we can elect section 179 on. And the deduction is up to $1,080,000. Some items we purchase are not eligible for section 179, but most of the things we would think of normally for business use are, but so that's part of what that difference entails. So to qualify for this special expensing, we have to place the items in service by December 31st. It's not good enough to just have purchased it on our credit card and we're waiting for it to ship. We literally have to place it into service. So if it's a computer, we have to plug it in and use it for business purposes before the end of the year. Recently, they changed the tax laws, so we're actually eligible to elect section 179 on rental properties, which we haven't been able to do in the past. So that's kind of nice. But I tell people to let's consider our actual need of our asset and not just the tax bracket. Don't let the tax tail wag the dog, or whatever that is. Make sure we really need it. And this goes back to, again, our projections and planning our cash flows, and also looking at our financing options, especially now with rising rates and maybe a little bit of a credit crunch yet to be seen. But let's make sure we actually need to buy these items before we spend the money. Another thing that has been really popular is bonus depreciation. We haven't seen bonus depreciation for a while until they just reintroduced it into the tax code. We had it back, I want to say, in the 70s or 80s. But right now, we can take 100% bonus depreciation. So it's kind of like the 179. We don't have to depreciate it over 3 years, 5 years, 10 years, whatever the IRS code section says that type of equipment is required. For 2022, we can still deduct 100% by electing bonus depreciation on it. Actually, it's not electing bonus because bonus depreciation is the default. If you choose not to take bonus depreciation, you make that election when you file your return. This bonus depreciation amount will be decreasing. As you can see here, it's going down 20% for the next number of years, and it goes back to 0% in 2027. So this was, a idea to help invest more in our companies and take advantage of the bonus depreciation, investing more, keeping more things in the country. I wanted to also note you can take Section 179 and bonus depreciation. So you really have a lot of flexibility in how you want to treat your assets. Switching gears here again. So when we're looking at and thinking about how to do our tax planning, we have to think about what's happening to income tax rates. And so I imagine most of you have seen that it's projected that these rates are going to increase. There are huge amounts of dollars printed to send out the special checks from the government to help everyone with the COVID related issues. And so tax rates are most likely expected to be increasing. There is a number of tax proposals out on the table, and all of them include tax increases. Again, states have been trying to work out something on the state and local income tax limitation, which was implemented a few years ago. That's SALT, state and local tax. So if you had been itemizing your deductions, you could take any kind of state income tax, property tax, that kind of thing. But when they put in that limitation, that dropped a lot of people out of that. So overall, you're limited to $10,000 as a deduction. So the states have been looking at trying to do some workarounds. And if you have multi-state entities, you might want to look at that as well. There may be a way to pay some of those state taxes if you're a pass-through entity at the corporate level. So take a look into that. So if tax rates are increasing, we maybe want to push some of our deductions into the subsequent year, maybe pay that last half of our property taxes, not in 2022, but in early 2023. We may want to shift when we're actually paying employee bonuses, maybe hold off instead of, writing the December 31st check, write a January 1st check. And we've pushed that deduction, which will be more valuable in a year when the tax rates are going to be higher. The charitable contributions, again, because we want to take more advantage of them for tax purposes, we may hold off until the subsequent year because we'll get a bigger bang for our buck. And I wanted to mention credit card deductions because IRS says if you put a charge on your credit card before December 31st, that you may deduct that in that year, even if you don't pay it into the subsequent year. So again, maybe we want to hold off a couple days and push it into the next year, even though we know we're not going to pay for it. And but still IRS says the date you put it on your credit card is when you're eligible for the deduction. But so what happens if tax rates are decreasing? Well, we don't think they are. However, the sort of opposite applies. You can't prepay any taxes. You can't pay something that hasn't been assessed early. That was one of the things people did when they first changed the tax law. They tried to pay several years of taxes in advance, but that is specifically disallowed. And of course, don't hold any of your bonuses or charitable contributions. Do them in the year so you're getting the bigger bang for your buck. And we talked about when credit card charges are deductible. Okay, again, shifting gears. Here's another one of my items. Let's talk about cars, trucks, and vans. So we can take for cars, trucks, vans, either the standard mileage rate, which is going to be 58.5 cents per mile. The mileage rate does get adjusted twice a year, but I heard some rumblings that perhaps there might be a special change because of the crazy gas prices that we've been incurring so far in 2022. So something may change on that. But for now, it's 58.5 cents. You do need a log for mileage. And I like Mile IQ, and no, I don't own stock, but I like the app. There's other ones out there. But if you have your app, you can almost, without any problems at all, track your mileage, which has always been the biggest problem for people, because they don't want to have to take out the book and the pencil and scribble every time they're in and out of their car. So one of these apps is ideal for monitoring that, because remember, IRS does require a log, and so you need to know what your date, place, and business purpose for your mileage is. And two, another important thing to think about is you can only take mileage from your business office. So there's commuting miles, which would be from your home to your office. Those are not deductible. But once you leave your office to go on any kind of business trip, they are deductible. So we're going to talk about home office in a little bit. So just kind of keep that in mind. Now, you could take standard mileage rate. You could also take actual, where actual, you again still need to track your mileage. But if you drive, say, 45% personal and 55% business, you'd add up all your actual costs and then apply that percentage to the actual costs. Now, we like to track both because we want to see which one is going to give us the bigger deduction. And I get asked, well, can we switch every year? Yes, you can. If the first year you place that vehicle in service, you select the standard mileage rate, then we can go back and forth. Generally, for newer vehicles, I find the standard mileage rate is going to give us the bigger deduction. But as the car ages and has more repairs needed, sometimes actual will be a bigger number. So we like to track both. So depreciation 179 and bonus for car, trucks, and vans, it's all a little bit different. You need to, 100% business use is pretty obvious, but you have to be at least 50% business use to get these kinds of deductions for your vehicles. So IRS recognizes 3 different types of vehicles: a passenger vehicle, an SUV, and vehicles over 6,000 gross vehicle weight. A passenger vehicle is limited to 18,200. This is for 2022, which is the bonus depreciation and the 179 combination, or just 10,200 if it's just section 179 that you're electing. So the maximum on a vehicle in 2022 is going to be 18,200. For an SUV, you're eligible for 100% bonus, but your 179 is limited to $27,000. For these trucks over 6,000 pounds, you're eligible for the full 179 and the 100% bonus depreciation. And so these are the commercials that we hear where, you can deduct your vehicle 100%, buy it by December 31st and drive it, and you can take the whole truck. Well, it's, certain vehicles that meet these exceptions. Generally SUVs, like I say, the 179 is limited to 27,000, but you can take 100% bonus, so that's still eligible. Your home office. Sometimes I hear a lot that people don't want to take it. It makes them nervous. They're going to get audited. And so recently, probably the last, say, 3 to 5 years, I lose track. They run by so fast. There are some special rules for home office, but it's where your principal place of business is, be it administrative only or where you're actually meeting clients. However, you don't need to actually meet clients there to qualify. The one issue with the home office is that you may create a little bit of taxable income if you sell that home because you took depreciation on the home. But generally, I find the number is not big enough, and sometimes the other tax savings are well worth implementing, even a small home office, because we need it for the mileage deduction. Remember, I said we need to be leaving from our business office to get mileage. If you don't have a business office, you don't have any place to be taking your mileage from. So you need to have some kind of even administrative small office, not even a whole room, part of a room, used regularly and exclusively for your business. This safe harbor method that they implemented a few years back, you can use your square footage up to 300 square feet, and you multiply that by $5, that's your deduction. So there's not a lot of complications with it. So of course, the maximum is going to be $1,500. You know, some home offices are going to be bigger. You may have more expensive or more extensive, larger size offices with more utilities, other things. So it may be worth using the actual standard method where you take a percentage of all of your home expenses, including mortgage interest, real estate taxes, homeowners insurance, utilities, repairs, anything related to the home, and you use the ratio of your home office square footage to your total home office, total home square footage. So that percentage gets applied to those total costs, and that's how you get your home office deduction. All right, again, let's talk about, we've got tax rates increasing. Do we want to accelerate income into 2022 instead of waiting for the higher rates in 2023? So we may want to accelerate income into 2022 and take our capital gains at our 15%, but not our losses, because our losses are going to be more valuable next year. We may want to encourage early payment from customers. So we report the income in 2022. We want those closings to happen. We want to encourage early payment of rent if possible. So ways that we can push income into 2022 to decrease potentially our 2023 income. So let's look at what the rates are, the brackets are for 2022. So you can see we have a number of tax rates. It was down to 3 or 4, and now we're back up to, what is that, 7. And you can see single filers are at 10%, 12%, and then they jump up to 22%, 24%, and you can see the same for married filing joint filers. And I also wanted to note that head of household have slightly different brackets. They're similar to the single up to the 22% bracket. And so when we're doing our planning, we want to take this into account and see what tax bracket we're going to fall into. And so if we're right on the edge of jumping into the next bracket, is there a way that we can push that income into a different year? Or perhaps knowing rates are increasing, maybe push more income into the year, even if our bracket does go up, because we know our bracket's going to go up even more in the subsequent year. So right now, corporate tax rates are a flat 21%. They're talking about increasing that corporate rate to 28%, 26%, a number of ideas thrown out there. I left the brackets in because this is the structure that we used to have prior to the implementation of the flat rate. And so you can see the brackets climb quickly for every $25,000 up to that $335,000 mark. So we don't know if it's going to continue as a flat tax, if there's going to be, some brackets again, but we know that corporate rates are most likely to increase. So what's some strategies we can use to maybe do something different to help us reduce our income taxes? Maybe we want to consider having our children work for us. We want to consider shifting income from our pockets to our children's pockets. Now, I'm not talking about, 1 and 2 year olds. I'm talking about our children who can actually perform services for us, because we want to have what's considered reasonable compensation for the services provided. One of the nice things about kids too is that we can encourage them to put their funds into an IRA and maybe even a Roth IRA, so they can be earning tax-free dollars, which maybe they could use towards their college education, or even, on down the road when they want to purchase a home, they have these funds available for them. So sometimes we encourage our owners with children to pay the kids and have them encourage their kids to put everything into the IRA. Another nice thing about shifting income to children who can qualify to file singly is they'll get $12,950 basically tax-free. And we took that $12,950 out of our pocket that we were maybe paying in at 24% and shifted it to a 0%. And so we've shifted that income to the kids and save tax dollars too. We might consider maybe gifting some income producing assets. A popular idea is to purchase a rental home where our children are attending college, and having them, rent some of the rooms to some of their friends. And so it, is income producing, but we have also shifted that income again down to their lower bracket and not ours. We want to be careful for children that have taxable investment income, meaning interest and dividends, because there are some special, what are considered kiddie tax rules for children that have earned income as well as unearned income, this interest and dividends. So we want to be aware of those items which could be thrown back onto the parent's rate, and avoid that if at all possible. What are some other things that we can do to shift income? Well, let's look at our stock portfolios. Do we have some losers that we sort of been holding on to, thinking they're going to turn around and they just haven't? Maybe in this increasing tax, we want to shift and sell out of those losers and take advantage of that capital loss. One of the things that we do want to take into account, though, of course, is talk to our advisors, our brokers. What do they think? Is it going to come back? Is it not? And should you take profits before rates increase? Should we offset prior year loss carry forwards? So there's a lot of strategies involved in looking at your brokerage portfolios and trying to take the best advantage of that as you can. There is something called the wash sale rules, and we want to be aware of that. So we can't sell something and get back in within 30 days and take that loss. That's not eligible. What about capital gains? So actually, there are some individuals that are eligible for 0% capital gains rates, and that's single up to $41,675. But the rates change, and so the current rate of 0 is then 15 for higher earners and 20% for even higher in earners. And so up to the 459,750 is the 15, and over that is the 20% for single. We've also got the different brackets for married filing jointly and head of household. And one of the things I want to mention about capital gains is that we have to look at them individually and then look at them with our capital losses. So we calculate our capital gains, calculate our capital losses, and then we net those. And the most loss we're eligible to deduct is $3,000 married filing jointly and $1,500 for any other. So maybe we do want to sell some of our gain properties and also some of our lost properties and kind of net out to no more than a $3,000 loss. However, those capital losses are eligible for carry forward and we can use them in the subsequent year. In our portfolios, a lot of times we'll have mutual funds. So be careful when we're buying and selling them. Know when those capital gains are calculated and allocated to your portfolio, and also when dividends are paid. So with mutual funds, you really need to talk to your brokers and or the fund management so you understand what's going to be on your 1099 for the year, depending on when you buy and sell those funds. One of my other items that I think is really important that we need to mention is that we need to consider our choice of entity. Just because you started your entity as a sole proprietorship doesn't mean it has to stay that way forever. Perhaps it's time to incorporate or maybe look at LLC options. So choice of entity is always relevant and we want to look at it every couple of years because as our plans change for what our businesses are doing, we may decide a different entity is more valuable for us. So besides the type of entity, we also have to consider what are our method of filing for taxes. Are we on the accrual basis or cash basis? I usually tell people we want to be on accrual basis for management purposes, but cash basis for tax purposes, although that's not always 100% true. So that's a conversation to have. You can only do that though when you first start up. So you would have to basically terminate your existing entity to change that accrual versus cash. Also to be aware of with an accrual basis, just because it's on your books doesn't necessarily mean you're going to get to deduct it because there is a special 2.5 month rule that says you have to have paid that accrued expense within 2.5 months to get the deduction. And then of course, related party issues, you don't get to take any accruals for related parties. Should you change your entity? When do you want it effective for? Do you want to get a W-2 paycheck? Are you going to take distributions? Are you going to do a combination? Sometimes higher compensation will give us a higher retirement contribution, which maybe is more valuable, especially when we're looking at a 401k where we can put in quite a bit to our retirement account and have a significant amount be a deduction from the employer. We do have to remember we're going to have some higher payroll taxes though. But then again, when we're filing at year end, remember we're paying self-employment taxes and income taxes, which sometimes is a really heavy blow if you haven't been calculating it throughout the year. So sometimes payroll makes it a little bit easier to deal with self-employment taxes. Remember, IRS says that if you're going to owe more than $500 during the year, you're required to make estimated tax payments or you'll be charged with an estimated income tax penalty. So sometimes instead of writing really big quarterly checks, maybe smaller W-2s are the answer. So it's all a lot of choice and a lot of discussion and a lot of planning and thinking about what is the best for you. So that basically is my top 10 tips for keeping your profits in your pockets. Number one was filing status. Let's not miss out on some opportunities for head of household if that's available. Let's look at maybe who will actually qualify as a dependent. Maybe we have some individuals we hadn't considered before. Let's take advantage of retirement plans that we can and select the one that's best suited to our needs. Be sure to consider the Section 179 and bonus depreciation and use that most effectively. We want to look at what tax rates are doing because we may want to accelerate income into the current year and maybe defer deductions into the next year. Potentially hiring our children in our business to shift some taxes into a different bracket and or gift to our children. Being aware of our capital gains and losses and doing something about our portfolios before the end of the year. Being sure to understand what's going to happen with our mutual funds. And of course, the last one, choice of entity, making sure that we're operating in an entity that's best suited for our business. So that is my presentation, and I am open for any questions that you may have for me.
So we do have one, and it says here, must you choose the entity prior to filing taxes, or is this something that we can do at the time of filing? Specifically asking about LLC filing as sole proprietor versus LLC filing as S Corp.
Okay, so yes, an S election must be made no later than the first, well, by essentially March 15th of your calendar year filing. So if you want to elect S corporation status for 2022, you're out of luck, because unless you started your business after January 1st, then you have potentially some time to make the election, but you only get those first, what is that, 75 days. So if you are existing on 1/1, you must make an S election by no later than March 15th. There's paperwork, there's signatures and things. So if you're going to do that, don't wait till the last minute. A sole proprietorship, there's no need to establish that in advance. And an LLC will come into existence when you basically do the documents. There's an organization document, operating agreement, and filing with the state. So those are specific things. You'll get documents from the state that say when you exist. So choice of entity can be changed, but there are certain dates and things that you want to be aware of. So thinking about it as soon as possible, not waiting to try to file and do something last minute, because there's not really a lot of options. When you go to file, you are what you are at that point. I hope that answered that question. I don't know if there's a follow-up, or it looks like maybe there's another comment or.
Yeah, so it says here, thank you. I will plan on S Corp before March 15th for the next year, if it makes the most sense for me.
Okay, good.
Yep. Other than that, I don't see any other questions.
Okay, well, I want to thank everyone for attending today. I really appreciate your attention, and I want to encourage everyone to check out the NMS BDC as well as SCORE. They have a lot of wonderful trainings and other things that you may be very well interested in. And I think Jackie can speak to that a little bit more.
Yes, thank you, Cathie. And I want to just thank you for the presentation and the valuable information. Thank you to all our wonderful attendees. And I hope that you all have a wonderful afternoon as well as the rest of the week. I encourage you to please visit our website at nmsbdc.org to view our upcoming no-cost webinars or to sign up for our no-cost counseling services. Remember, the NMSBDC is always here to help at any stage of your business, and please feel free to reach out to us. In the chat, you will see some important links and information that you can get for on-demand as well as YouTube. And there will also be a follow-up email to this with the survey, which will include links for on-demand, YouTube, as well as the presentation slides. And with that, I wish everyone a great day.
Thank you all.